So welcome everyone. Welcome to this webinar Market Thursday. It's February the 4th. I'm in London. And we're going to have some topic about macro trading and obviously GME, which was last week. Just as a quick disclaimer, just to remind you that those webinars are not investment advice. This is for information only. So please do your own research before doing anything. Similar, so be careful. This is really for me to trying to help you. So quickly, my background, I started in 2000 in Paris as a cash equity trader, working for an asset manager, Pierre Charon Gestion. Then I moved to London in 2004, working for a hedge fund, first on the long only product, then on the long short product. From 2009 to 2018, I worked as a prop trader for Infinity Capital Markets here in London, which is a subsidiary of First New York Capital. And then in 2014, I worked for another mentoring company that I left in 2017. And in 2018, I restarted my own mentoring program, launched last year, or more than last year now, in 2019, the 4x4 video series, and I'm still mentoring people. And I restarted doing some prop trading over the last couple of weeks for this prop trading company. So what about today? What are we going to be covering? So as usual, if you have been following some of those webinars, we're going to be doing the situation across asset classes. We're going to be talking mostly about the 4 asset classes: stocks, credit, commodities, and FX. Looking at the recent performances. Then we're not going to do too much of the next catalyst, which we are in the middle of the earnings season, and the possible catalyst with the central banks. We had the Bank of England today. So to save a bit of time, do your own job for the earnings season. It's not that complicated. You get several websites. We're going to be doing a bit of macro with the ISM Manufacturing and the world PMIs. We had as well the services, but I think covering the manufacturing is a good thing. Then we're going to be discussing what happened last week, and start of this week is the GME and the short squeeze. So let's start with the situation across asset classes and looking at what and how the different assets have been performing year to date. Similar to last year, the Bitcoin finds are in town. Bitcoin is up 30%. That's the outliers. In terms of risk on across stocks, all these stocks indexes are up for the year. But what you can see is really the outliers are the Russell 2000 and emerging market. So Russell has been doing incredibly well since the election. It's great. I think it's closing tonight at 2200, up 10% on the month. So this performance was as of yesterday. So you should be adding another 2%. So literally small mid exposure to the US have been doing extremely well. In terms of currencies, the dollar is strengthening a bit. So we saw at the end of last year that there was a weakening from let's say June onwards of the dollar between 5 to 10%, and since then there is a bit reversion to the mean. So the dollar is a bit stronger. For the at the end of this slide, on the right-hand side, we get the commodities. So gold was very weak today, very weak, maybe it's a big word, but it was weak at 1800. And WTI has been doing very well. As we discussed a month ago, the cut from Saudi Arabia that is coming of 1 million barrels is helping. Having said that, this is still a strong performance now that we are trading around the between $55 and $60. So pretty strong performance. On a weekly basis, same picture. Bitcoin has been strong but very volatile. But you can see as well that the stocks overall are up 2 to 3%. So we had a dip last week on the GME and some dislocation in the market, some unwinding on some position, which we're going to be explaining later. and that is for the asset performances. What I like to do as usual is to be looking at the different sectors that are making up the S&P 500. So we get 11 sectors. Energy, based on the strength of the WTI, is up 10% on the year, so very strong for the year, followed by consumer discretionary. On the other hand of the spectrum, we get consumer staples that have been pretty weak. So what you can see here as well, that the market is going higher, but with no real leaders. So it feels like everything is going up, and no, still you're gonna have some names that keep on doing well and well and well, as we've seen today with the PayPal and everything that is payment, that was extremely strong. But there has been some rotation, this rotation based on some allocation going from the S&P to the Russell 2000, and this is why the Russell has been outperforming like crazy the S&P. Similar, looking at the other asset classes, the bonds. So this one, year to date, bonds have been down and yields up based on the reflation. So a lot of expectation of the US economy and the world economy is doing better soon, and as well possibly inflation coming into the system, which is still the unknown for the next few years, and that's going to have huge implication for the other asset classes. But the US 10 years is up 20 bips on the year. Similar for the UK. I put the Italian one. Why? Because for us living in Europe, that is a good proxy of how risk on, risk off. And as Super Mario is back and actually will probably be the prime minister in Italy, the spread between the German Bund and the Italian OAT is at less than 1% now. So it's at 5 years lows. In terms of VIX, make no mistake, I don't consider that the VIX is an asset class. I just look at the VIX as an indication of the implied volatility and how the market is moving. So the VIX is at the same level that it was at the start of the year, but in between, as you probably saw, we went from 22 to almost 40 as of last week. So there is a lot of volatility in the system, and as well, there is high volatility, implied volatility versus historical volatility. In the winners and the losers section, as usual, you're going to have a lot of biotech that are making the winners. But on the losers, those are actually the reversion from the winners from the month of January, which were many of those names were short squeeze names. So the GameStop is unfortunately, I get the wrong number, but that is the story for the losers versus the winners. Let's go back now. I'm going to show you. We're going to go through some chart very quickly. If I find where is my chart. Okay, so let's start with the this one, which I think is interesting, with the Russell 2000, which has been on fire as we just discussed. Since the election. So here you get the breakout from the election, and since then we have been up 500 points. So that's roughly 30% in 3 months. So extremely strong performance. If we look at the S&P, so let's put the SPY. The SPY is making up. If we do SPY, so the SPY is closing at all-time high. So very strong. We have the NFP tomorrow. So as usual, people don't like to be putting too much position going into the NFP, but very strong market, equity market, and actually the Nasdaq is not necessarily that strong versus the other market. If we look at the S&P versus the Russell, so here this is the SPX versus the Russell. You can see since we had just after the election, we had this massive move. So if you have been long the Russell and short the S&P, well done to you. Another sector or index that I like is the Philadelphia SOX index, which is for semiconductors. Not making highs yet. I'm not going to say it's struggling because we are only 4%, 5% from the all-time high. But that is something that you should be monitoring for the risk on, risk off, even if risk off is completely out of completely useless these days. Commodities, quickly, I'm going to do CL1 if I find the CL1. So let's do CL2 here. So that's for crude oil. So crude oil, and I take not the first month, but the second month because there is no negative numbers. So we closed the sell-off that we had since the COVID. We are coming to the very important level around between 55 and 60. That is, to be honest, pretty impressive. As I said, Saudi Arabia cutting production is really helpful. There has been some talk as well that with the vaccine coming, we're going to have in 3 to 6 months some good restart of the economies. But that is very impressive based on the idea as well that there is a lot of oil reserves that are standing there. For the gold, where is the gold here? The gold, where is the gold? So that's one of the gold. So gold, there is, because I know that there are many people that are long the gold, there is some support now. If you're long at 1760, that's probably the level that where you probably going to see a bounce. I think the speculation and the unwinding of the silver from Monday to Tuesday has not been helping. Because if you put people and do a lot of speculation on the silver and then you need to unwind, by repercussion, the second derivative is, in that case, is the gold that is unwinding. If we look at now the copper is at so let's do a regular chart. Support the copper is consolidating. So since the dollar has been strengthening against other currencies, the commodities are trading sideways, and I say commodities like copper, and it feels like very much that all those commodities are very correlated with dollar. Only the S&P is doing very well actually versus the strengthening dollar. Quickly, because I don't want to be spending too much time, where is my 10 years US? So that will be into the euro. Here, this is my US 10 years. So your US 10 years, 110. If you think that we're going to be coming back to where we were before the sell-off, that's 150. That's your target. There is not much between 110 and 150. I'm not sure that necessarily the Fed will be so happy about the 10 years going up that quickly, but this is the possibility. And if you look at the 10 versus the 2, there is still a steepening of the yield curve. Okay, so still ongoing steepening of the yield curve, 120 maybe. Quickly with the currency, dollar, you can do almost any currency. Against any currency, the dollar has been strengthening a bit. So we had, as I said, massive sell-off of the dollar from June onwards. And since 6 weeks, the dollar has been strengthening. I told you before, when we look at the euro dollar at 122, 23, it felt to me that it was a bit too much. I think there is a possibility of a reversion to the mean up to 117, 118. I still believe that the sterling could go into the 140. So actually the sterling has been doing better, and the Japanese yen, there has been some decent move over the last 10 days. So let's go back to here. And let's go back to this presentation and the central bank. So each time I do those webinars, especially I think the last one was a month ago, I like to be talking about the euro dollar futures, which tells you a lot about what are the expectations towards the Fed in the future. And so if you look at this 99.83 in February 2021 versus March 2023, you can see that there is not much. That tells you, in other words, that the market participants are not expecting the Fed to do anything at the moment before the end of March. So there won't be any rate hike at the moment priced by the market until September, I think, 2023. So that gives you 2 or 3 years of cheap money. So that's something. Always check what are the Fed expectations and what are your Fed expectations and what are your inflation expectations. Market is going higher. It is helped definitely by the balance sheet of the different central banks. So that's always something that we need to keep in mind when we are trading, when we are investing, either in the US with the Fed or in Europe with the ECB, or in Japan as well. They massively increased the size of the balance sheet since the lows in March, and they keep on doing it. And if you read what they have been saying, they are targeting and they are decided to do it until at least the end of this year. So you're going to have another 9 months of those balance sheet charts to go north and north. So let's start with a bit of macro. As usual, we do a bit of everything, price action and macro trading. So here it is about macro, and this is about the world PMIs from JP Morgan. So we were a bit lower this month from the previous months. Still, this is a this is a very strong month, to be honest. This is the follow-up from the end of last year. There is still the confirmation. Why the global manufacturing is a bit peaking is because we have some places in the world, like for instance China and Brazil, that are where the growth is slowing from very high levels. But overall, if we look at the pictures, not only mine but here, so if you look at the pictures, it's very, very strong. All the big names and even Europe, if you read the numbers on Monday, were better than usual. So overall, very strong read from the PMI manufacturing. As I said, I think there is still there is a bit of a caveat, which is emerging market through China and Brazil are doing a bit less strong. I think this emerging market trade that has been working very well, not for me, but very well from some others, might be coming to a pause now. In terms of the US ISM manufacturing, what we have is still a strong number. Maybe it's a peak, but we are talking 58.7%. So as always, we try to find, to identify the possible end of a trend. What is interesting is similar to last month is the prices that are very high. So prices are extremely strong. Again, the Fed has been saying that this is due to some friction in the system, and clearly there is friction due to a shortage of labor, cost of commodities, and some other factors that are not helping inflation. Keeping in mind that a bit of inflation would not be that bad. New orders are coming down. So again, we were coming from high level, but still, that was a very good report. New orders trending well. And as I said, prices on the way up. In terms of sectors, for those of you who are doing the NAICS screening, so the sectors that are trending very well for this month are the ones and the same that we had 2 or 3 months ago, which are the cyclical names. Okay, so we go for machinery, chemical products, transportation equipment. So those are the sectors that have been trending very well. We started to identify those sectors in around June, July last year, but now there has been a reacceleration of those sectors recently. On the other hand of the spectrum, we have textile mills and printing that are not trending very well. Keeping in mind that those two sectors are not easy to do some ID generation. Okay, so don't be too frustrated if you don't find so many names, but that tells you that at the moment, the US economy is doing very, very well. So what about we do a bit of GME? So GME, the players. So it's going to start, and it started with the retail traders with the Wall Street bets. So you get an army of retail traders. You get the professionals with Melvin Capital and 0.72. You get the other router, which is Citadel, which is making 30 to 40% of the US market share. Okay, so what does it mean? That means that when Robinhood is making is putting an order in the system, they are taking the other side of the market of the order, then they are flipping it into the market, and that's where they are making their money, which is the spread. The good thing is the other router, which is Citadel, with 0.72, which is a hedge fund, invested first almost 3 billion last Monday when Melvin Capital was in trouble. Okay, then you got the broker, that is Robinhood. You get the social media guru, and you get the shareholders, which are Citadel. So Citadel is a shareholder, Citadel is another router, and you have obviously the conflict of interest between hedge funds, the broker, the social media guru. So that means you have a mix of people that are doing the wrong thing. And if you put that into a stock that is heavily shorted, as we're going to see, it's a recipe for a massive short squeeze. So at the end of this slide, I put the regulators because you want to believe that at one stage that normally in a situation like this, there is a regulator. If you want to be a bit sarcastic, let's say that, for instance, Yellen, between the job as the Fed, between the Fed and the Treasury, I think she did 3 presentations worth almost $1 million for Citadel. So there are conflict of interest everywhere in those cases, which at the end of the day, you should care to a certain limit, because what you really want to do is to be making money. So what happened with first with the Citadel of this world? So Citadel is now managing roughly 30 to 40% of the volume. So each time there is an order, or let's say 30 to 40%, there is an order on the US market, Citadel is in charge of it. And that means that they can see the flow. And that's the same with Virtue to a certain extent and some other names. So if Robinhood is using Citadel as putting the order in the market, Citadel can see exactly what they are doing. And that is obviously an issue. And the idea comes is because Robinhood thinks that everything is coming for free. So they don't ask their user to pay for anything, and they get some kickback from Citadel with their orders. So again, you can see the conflict of interest. It's just a huge mess. And that tells you as well that you should be checking your broker, but that we're going to be seeing at this later. So in other words, that gives you GME. So GME, now you probably, if you are following this webinar, you've heard of that story. So the stock was trading, I think, at $5 6-9 months ago. And then suddenly, from mid-January, it just started to move up and up and up and up, and massive squeeze. So that's the chart. That is a regular chart. This is not a logarithmic chart. We traded last week, I think, in pre-market around 500. I think there was a print at 500 or plus. And we closed around the 50s today. So obviously, when you see a chart like this, you will say, oh, that's easy. I will be selling here, and I will be buying here. Always easy to do in hindsight. The reality is much harder. So what happened here? We got the GME short interest as a percentage of the float. So for those of you who are new, you can be obviously buying shares, but you can be selling shares. To sell shares, you need to borrow those shares. So imagine that you want to be selling GME. First, before selling GME, you need to ask your broker, Interactive Broker, Nomura, Goldman Sachs, whatever. You call them and say, look, do you have 10,000 GME that I can borrow from you? So one person X will lend you these shares and you will pay him 1%, 2%, depending on the borrow. And as long as you get the borrow, you can go short sell those stocks with the idea of selling them at a price and obviously buying them at a lower price. What happened is the short interest as a percentage of the float. So the float meaning the shares that are really available to trade. You can see that from the start of 2019, the short interest went from 20, 30% to more than 100% at the start of this year. So that means that the short interest was completely out of control. So I remember looking at it last summer, looking at GME, which was trading, I don't know, 10, 15, 20. And I look at the short interest, which was at 100%. When you have a situation like this, it's called the corner, which is there's a possibility of a massive short squeeze. And look, make no mistake, I was not long and I didn't make a fortune out of it. But in a situation like this, when you have too much of short interest as a percentage of float, this is a recipe for disaster. So here we get the GME share short on the left-hand side. So those are the numbers. And on the right-hand side, we get the GME short interest as a percentage of the float. As you can see, again, from over the last 12 months, steadily, slowly but surely, the short interest went up and up and up and up. So that means there were too many short in the system. When you get too many short in the system, and at one stage, some people are buying it, that gives you the short sellers, people that are short the stock, will have to buy it back no matter what. Okay, and this is what happened to Melvin Capital. So if you look at Melvin Capital, there was some story that they were long put. If you are long put, actually, normally, if you're squeezed, you're just leaving the premium on the table, and that's fine. So probably there were long put and some short calls and short stocks. I don't know what exactly, but actually, they were very short as well. So you have some hedge funds that do long short, and that had, in that case, too much of a short. So that means if you put Robinhood, an army that is telling you, okay, you should be buying those stocks. In that case, that was GME, that was EMC, that was all those names. Plus, you get on those forums, and actually, it seems that it was not only some Robinhood traders that were doing it, but that they had some helps, probably some from other hedge funds to do the squeeze. You go from a stock that is trading at 200 to 500. But because the regulator at one stage want to be looking at it, it will jump. So what happened is last Wednesday, I don't know if you remember, but the first question during the Fed meeting that was asked to Powell was, what do you think about GME? When you asked to the Fed chairman the first question about a single stock, you know that the regulator will have to do something quickly. And guess what? The day after, just before they open, Robinhood, all the retail brokers said, look, guys, we are, you need to reduce exposure. So that means now, as you need to reduce exposure, you're not allowed to buy these stocks. Why? Because we don't want us to be squeezed even more. But what was interesting is Robinhood was really the place where they lost a ton of money. Okay, so they lost probably 3-5 billion or more. If you look at brokers like Interactive Broker, what they told you is through the system, when there was a margin call, they cut your position. With Robinhood being so big, having so many new customers, and not having the risk management, they were not able to cut people. So once you get the margin call with a decent broker, they will cut your position immediately. In that case, they did not. Okay, so they cut the position, but with a loss. And as they had a loss, what you need to do if you want to carry on, you need to call your shareholders. And who are your shareholders? Citadel, Citadel, okay, which is making 30 or 30% of the flow, and 0.72, which is as well running Melvin Capital, okay? So that means the conflict of interest is again still massive. Here we are looking at implied volatility. Why I want to be discussing implied volatility or volatility, it's not implied volatility, it's historical volatility. So you get the 5 days, 15 days, and 30 days for GME. So last week, what people told you is, oh yeah, it's easy, you know, in a situation like this, what I do is you should be buying put. What you should always check when you buy options is you buy an option with a certain level of implied volatility. And when the implied volatility goes to the roof as it went last week, buying some put is not necessarily the best idea. And as well, if you are selling some call or if you are selling any volatility first, the first move, you never know when the volatility is going to stop, okay? So if you tell people, oh, I sold 10 days ago some call on GME when the stock was at 90, when it goes to 500, you get the margin call from your broker and you're probably almost dead. If you're buying a put, and we're going to see that, I think it's in the next slide. If you bought the put, for instance, 60, that is expiring on the 19th of February. So let's have a look here. So that was on the 27th. So on the 27th, 28th, that was almost the top of GME, okay? So if you were buying the put 60 at $15, a couple of hours ago, it was trading at $14. And in between, the stock went from 350 to 60. So what does it tell you? That tells you that you were buying just the put at a crazy implied volatility, meaning the premium was just extremely, extremely expensive. So to do these trades, one way or another, if you buy the put, that means implied volatility is very expensive. And if you short some implied volatility, you never know where it's going to be ending. So yes, obviously what you should be doing, what you could be doing is some spread, but the spread, if you do a put spread, the reality is most brokers last week didn't give you access to the put spread on those names. Okay, so last week, if you were asking for some borrow on GME, there was no borrow. So when I see people telling me, oh, I shorted GME at 350, bullshit. When I see people telling me, oh, I did a put spread on this, bullshit. It was just not possible. So always in those situations, make sure first, here this is for the option, because I know that you get many educators, many traders that are going through options. Try to understand the basics of options. One of the most important things is implied volatility. Next one, it's kind of a checklist of what you should be doing in those cases. First thing first is for any stock, when you go short, check the short interest. And I can tell you that each time we do that with my mentees, we ask, what is the short interest? So how many shares you get as a percentage of the float? How many days it will take to cover? The concept of days to cover is a bit of bullshit, because obviously if there is a frenzy, suddenly it goes down. But you could be using shortsqueeze.com, nasdaq.com. The second thing that you'll need to be doing is check the borrow. So if you go for brokers that are pretty defensive, like Interactive Broker, most of the time for those crazy stocks, there won't be any borrow, okay? Anyhow, for most retail traders, it's very hard to have the borrow. I can tell you that I've been trading professionally again for the last 10 days, and there was no borrow on GME. But what you should be adding in, if you have Interactive Broker, for instance, is a column that is called fee rate. And the fee rate is the cost of borrowing the stock. Okay, so as of Tuesday, it was at 17%, but actually the borrow from Interactive Broker just came back, I think, today. So add a column on your platform where you're going to know what is the cost of borrowing this stock. Normally, if the stock, if the borrow or what we call the locate when you're working in the industry, if there is easy locate, that means you should be able to borrow those stocks from less than 1%. The harder those stocks are to borrow, obviously, the more expensive it's going to be. So that means the person that is lending you the money, lending you the stocks, is asking for more. Most of the time, this is not the person who owns it. This is the prime broker. This is the bank. This is they are just making extra money out of it. When we look at GME, always be checking what is the implied volatility. So first thing first, for people who don't know what is implied volatility, do a bit of research. But if you look at the website like cboe.com, they will give you what the implied volatility, what is the market pricing in terms of move in the future. And that means, if the VIX, which is the implied volatility for the S&P, is at 22% tonight, that is your benchmark. So that means if you have something at 50, 60, 100 more percent, that is a very high implied volatility. Implied volatility, I think on GME went up to 1,000%. So that means it's like buying an insurance on your house where you have 100% chance of your house to be burning. So that means the premium is going to be extremely expensive. When there is no borrow, what you could do, and what I did, is you need to be checking which ETF have exposure to that single stock or to those stocks. So I found XRT, and I'm going to discuss that a bit to tell you what I did, what was my strategy. But I wanted, as I knew that I didn't want to do options. I could not do the stock, but actually I was lucky to not be doing the stock, but I still wanted to do this trade. I tried to find ETF that had exposure, and I found XRT. When there is dislocation like this one, and that's what happened here is it happened to short sellers. Okay, I don't think they are pure short sellers. They are only long. So they are long only. They are long short hedge funds, which actually were way too leveraged. Okay, so if you think, for those of you who have done the 4x4, this is any videos above 30, which is about risk management and gross exposure. When you get a hedge fund, most of the time, if I give you 100 million, if you are running 100 million, in reality, you're going to have an exposure of between 300 million to $1 billion. Okay, and that's what we call the gross exposure. I'm pretty sure that for Melvin Capital and those world, we were talking 500 or plus gross exposure. So that means suddenly everything goes wrong. And that could happen on the way up, and that could happen on the way down. And that is exactly what happened in 2009. That is exactly what happened in 2012. When you get some hedge funds that are in trouble, what you need to do, and that's horrible to say, but you're a bit like a hyena. You'll be looking at what are those different hedge funds holding, because you want to know what positions they need to get rid of. Okay, so if we look at Melvin Capital, for instance, they were short some other names, and they had to buy back those names. But remember 5 or 6 years ago, there was a fund that was way too long, and actually you had to sell all these stocks at the bottom. So try to find the names that those different hedge funds are long or short. So this is about checking similar situations that happened in the past. I think what is important is last week I tweeted on saying, you don't want to be a short seller these days. I think we should not be blaming the short sellers. I don't know if you remember last year we did some webinars about Wirecard and some others. There are some really good guys that are doing the work. And the good short sellers are trying to find the good names. It's just here, I think it's more a question about the bad risk management, where you get too much gross exposure, one-way traffic, too much concentration, and probably, if you look at it was not only Melvin Capital, there were some other names of traders that used to be working for 0.72. So it's several places that are the same position. Finally, here, always check the quality of your broker. And I'm sorry for all those retail traders, this army that started to trade last year. But I said it several times. I did a YouTube video about telling people, be careful when you check your broker, because even if it comes for free, there is a reason, okay? And the reason was they were giving the flow to Citadel, and Citadel were giving them a bit of money because this is the order flow. But that means what? That means Citadel is the market maker. Okay, so Citadel is seeing all the different position from all the players. So check your broker. I think, you know, it's you're never safe with a broker. There is always a risk. 2009 was a good example that even big places could go down. But I think try as much as possible to go for the big names. I go with Interactive Broker. I'm not taking any kickback from them, just to let you know. But I'm not pushing from this small local, let's say UK broker and so on, others that you have the names, you don't even know what they are. So be extremely careful when some educators are telling you, I don't take any feedback, I don't take any kickback, sorry. There is always a kickback one way or another. You can be paid with your Bloomberg or some other stuff. So check your broker, go for the big guys. This is where you're going to be safe. So what about the trade? That is probably the only good trade that I did over the last 10 days. So I tried to look at what was and where was GME exposed. And I found out that 20% of the XRT was GME. And actually that was a bit weird because normally XRT is really saying we only get 1-2%. So we are equally weighted for all the names. But because of the move of GME on the way up, that completely dislocated the percentage. So normally, if you are a good ETF runner, they should have been selling GMEs days after days after days, just to have 1-2%, but they didn't do it. So that means XRT was on fire, and as well, you had a 20% exposure. So here, that was from a week ago, where you can see the exposure where it's at 20%. So this is from my Bloomberg here, giving you the picture, but you can have exactly the same picture on website like ETF. So what I decided to do is I went short the ETF. Why? Because on the ETF XRT, there was some borrow. Okay, so when I asked my prime broker, borrow was available, which was not for GME. So that was not the trade of the century. I made something like 10%, but actually the risk reward was so in hindsight, this is not necessarily the smartest trade I ever did, but that to give you a bit of what to do in those cases. If you were looking last Thursday, last Friday, last Wednesday, there was a lot of noise around GME. In reality, no one was trading where there was those trades with XRT. You could have as well be doing options on GME. The second derivative of the GME trade is, as you know, many of those heavily shorted stocks were squeezed in January. So as always, when you look at something, try to think about the second derivative. And the second derivative in that case was any single stock that has a 20% plus short interest was squeezed on the way up, because those hedge funds, not only first, those hedge funds were short, not only those hedge funds, and you had a manic move on saying, okay, where are the short interests? Where can I push for the pain? So ex-GME, the performance of the stocks, the US stocks with more than 20% short interest was, I think, 45% on average return. So 45%. So what you could be doing is, if you do a bit of coding, you go on Short Squeeze or you go on Nasdaq.com, and every single day or every single week you check what are the most heavily shorted stocks, because you know that at one stage there might be danger. And more importantly, if you want to go short a stock, go back and check those names. So GME, just to finish on it, Melvin Capital. So Melvin Capital was running 10 billion. This is a long short hedge fund. I think the risk management was obviously not right. They did it very, very wrongly. That happened. But what was interesting is to try to find the names, as I said before, where GME was involved. So actually, I think Zero Age at one stage posted that. But if you had access to a Bloomberg, or if you have access, or if you could look at some short website that gives you short interest, you could see some names in Europe, for instance, where Melvin was short. Evotech was one of the name. Varta was another name. So Evotech, I think, opened at 43 last Wednesday, then it came back to 32. Varta went to 180 and now it's at 150. But what you can see here, this is the short interest that they were carrying, that the short interest came down massively. So they had to reduce no matter what the position. So either the prime broker called them and say, look, Melvin Capital, instead of having 1,000% gross exposure, you need to reduce this 1,000 exposure to 500 exposure, or the shareholders of those funds we're calling them and say, look, guys, you need to cut because we are losing way too much. So there were forced buyers and sellers. So they were forced to reduce their exposure. So again, when you look at those stress case scenario, try to find the second derivative. What could be the implication? The biggest warning that I want to give you is looking at options and implied volatility. The thing is, the outlier move, you never know when it's going to stop. So as you never know when it's going to stop, if you go on top of that with shorting volatility, it's a recipe for disaster. So my conviction over the years, even if you think that sometimes there is a good case for shorting volatility, I know at one stage it's going to be in your face. So anyone, all those educators are telling you, oh, I shorted this volatility there and there. Reality, one day they're going to be crying. So don't do it. It's not worth doing it. And as well, what we saw with that case with GME is, despite the big move from 450 to 50 today, or 60, if you were buying some only put options, because you will have bought implied volatility at 1,000% last week, you will not have been making any money. Okay, so that was for the GME. I hope it helps. Last one word, I think it's very important to check the quality of your broker. It's always nice not to be paying for something, but paying a bit for a broker, it's going to help you because they are real professional. There is a good YouTube video about the Interactive Broker CEO actually explaining that their tools are in place. That doesn't mean that in the future they cannot have a big problem. But when you're running positions for millions of people, you need to be able to cut them quickly when it's needed. And Robinhood was not doing this. So I strongly advise you. I know that every 3-6 months there are people coming to me and say, look, my educator is asking me if I should go from this, let's say, UK broker to this UK broker. I've never heard of him. Look, if you do 2 minutes of this UK broker, you will realize that they are not that nice. So when I tell people, go for Interactive Broker, go for those big names, I don't take any commissions. It's just, this is my conviction. Your risk number one is the counterparty risk, which is your broker. So think first about where you put your money, because otherwise, in a week like yesterday, last week, first you will have been cut, and probably you will have been cut after, and meaning you'll have to be putting more money. You'll have a margin call and another margin call. So quickly, to finish that, to give you a bit more color of my education, 4x4 video series, that's a comprehensive online video course to get a professional investment process. This is based on my 20 years experience in a hedge fund, in a long only, and as a prop trader. I launched this product in October 2019. I think so far the subscribers are very happy. The feedback is really good. I think people have done other education and they realized that there is better than those education, so they are very happy. It's about ID generation, 4 ways of doing the ID generation: top down, bottom up, special situation, and active trading. So this is what I do in my job, and this is hopefully where I can help you to do and generate IDs and trades. You're gonna have 40 plus videos, 30 hours of footage, and 50 plus Excel spreadsheet. I recently changed the website, so I think the, how do you call that in English? The user experience is much nicer than it was 6 months ago. So hopefully for the new subscribers, it's even better. And the mentoring program that goes after the 4x4 video series. I think the 4x4 video series is already good enough. That means you could be managing your own money with the 4x4 video series. But the mentoring program is mostly about implementation. So this is a 12-week one-on-one online sessions that we do with Skype. We share IDs, we share screens, and I'll help you, similar to the 4x4, to do those 4 strategies: first building your infrastructure, and then looking at the different sectors and the different strategies. For those of you who want to have access to the industry, this is a way to build your track record. And this is about it. What time do we have? Should we do some questions? Anyone? So there are some Q&A. Let's do some quick Q&A. Question for Mark: if you are long a stock with a high short interest, then it actually may be a good sign, assuming you have done the work. Yeah, you're right, Mark. Let's put it here instead of, that's exactly what happened to some hedge funds that bought the stock at 5, 10, 15. And they say, I like the story, the management is buying shares, and the short interest is growing, and a squeeze is coming. To be honest, this is the not the mother of all squeeze, because we had Volkswagen in 2008, but still this is a big one. I think what was quite crazy that time, it was not only GME. So whereas in 2008 you had Volkswagen only, these days you had 20, 30 names that move, like BlackBerry, like I don't know. All those stupid names that move like crazy. And that proved you that there was dislocation in the system. So question for Mark Ellis: can you explain the difference between working for a prop trading and a hedge fund? When you're working for a hedge fund, you get clients that are subscribing to your product. So you have normally high net worth people, where the minimum ticket is $100,000, and they buy in the fund. So that means you'll be working for those people, okay? And you're gonna have fees, kickback. So the commissions normally they used to be 220, now they are much less than that, because 220 was too much. When you are working for prop trading, this is proprietary money. So that means there are partners that are putting their money on the table, and traders are working with it. So that's a very different proposition. And that means the profiles, the prop trading is much more aggressive. So that means the balance sheet is much more leveraged than hedge fund, like we are talking like much more. And the strategies are more aggressive. Do you only trade US stocks or do you trade global? So these days I trade more Europe because I restarted, so I came back a bit to my core. Today I did a trade on one of these FVVR crazy names that jumped and came back. The compensation is not the same, Mark. It's a very different compensation. So prop trading, you're going to have a higher compensation, higher formula. But normally in a hedge fund, you're going to have a big salary. So when you work for prop trading, you don't have a salary. So everything is based on the formula. But if you have questions, I'm very happy to have a call with you or, and having a Skype. So please send me an email. Eduardo, the GME frenzy moved to the narrative, let's break the banks. This narrative has clearly failed. What are your thoughts on silver? I think I read, like any of us, the conspiracy theory about the manipulation from one of these big banks in the US that I'm not going to name. I think the failure on the short squeeze in silver is telling you that if you want to do a pump and dump, because that was a pump and dump from social media, from those PAX guys and from some other people through Robinhood, you need to have a market that is not too big. And if the market is too big for you, which is the case for silver, then you're failing. So that's good enough to do a massive short squeeze on names on names that are already squeezed. On a very liquid market like the silver, it is much harder. What else do we have? You do use the ISM PMI for the US. Because Samir, if you look at the ISM PMI, actually the detail is much better than the IHS market PMI. So you have so they go through sectors, they go through the NAICS nomenclature, which is much more diversified than the market PMI, which is only one number. Question from Angel, if the options were available, isn't it good to play a short with bear call spread? If bear call spread short, I don't think that works that way. What else? Ingo, hi Greg, European traders cannot directly trade US ETFs. There are some extra London Paris listed. So actually, I think you can be trading them. I think for you, Ingo, I think if you go through a company, you can trade them. This is what I did. I think you can be trading some ETF through CFDs. Otherwise, yes, there are some listing in Germany. There are some listing in France and in the UK. There is a website, I can't remember. Send me an email and I'll try to send you back the website that gives you the different ETF for Europe. So we got Donald Trump tonight. That's nice. When I'm going to be starting my own hedge fund, it's a tough one. It's a tough one because starting a hedge fund, you need at least 30 to 50 million, and raising money these days is a tough one. For the option questions, I think it's going to be taking too much time. Question on Melvin Capital, better manage their risk in that scenario. Look, I hate when giving listen to anyone, especially when people are running billions, because you never know what's going to happen. And I can tell you, I work for Madoff, and I never saw that coming. So I think that the bottom line for Melvin Capital is if you are running a gross exposure that is too big, then you get nothing under control. And leverage goes both ways. When I say to retail traders, be careful on your exposure, that is the same with professional. Look, I remember when I was working for a hedge fund 10 years ago or more now, we were running sometimes 500% gross exposure or plus. So imagine when everything goes wrong. When everything goes wrong, that's a proper disaster. Let's put it that way. If the market is moving, let's say on average 10, 15% every year, and you get some guys that are making 50% plus, it's not only because they are good stock pickers, it's just because they have massive risks, okay? And the massive risk, when it's not working, it's in your face big time. So this is what happened to them. I'm not sorry for them. You know, it means that they had a bad risk management. If you lose 70% in 2 weeks, sorry for my English, but there is a fuck up, okay? And that means you have too much leverage, too much concentration, no stop loss, no liquidity. So that means, you know, if you run 10 billions and you say to clients, look, we are running 10 billions, don't worry, we're gonna have a good risk management. Clearly this is wrong. And they were saved by some other hedge fund by closing this position or for forcing people not to trade. Okay, for other questions, maybe send the email because it's too much. From personal experience, I like this question. Did you prefer working for hedge fund or prop firm? I really loved hedge fund. Hedge fund, even if I was complaining because I'm French and I'm always complaining, working for a hedge fund was really, really nice because I was in my early 30s or not even. And I was managing a decent book and I was meeting CFOs and I was pretending that, you know, I was very, very smart and so forth. So life was extremely good, but the hedge fund from 15 years ago were almost all dead. So it's still surprising when you see those Melvin Capital because there are very few names that could have those kind of swings. Prop firm, the prop firm that I'm working for, you have like superheroes. And when I say superheroes, that people that are printing money every single day. But when I say printing, they are literally printing money. So it's very pushy. But it's a very hard environment. Okay, so it is a tough job, really, really tough job. Sometimes I like, sometimes I don't. I mean, you have the answer. It's very related to the P&L as well. Okay, you do this job to. The bottom line is your P&L. Okay, prop trading is all about trading. Hedge fund, there is a bit more than only trading. There is strategies, there is meeting people, there is some other things. So if you ask me, I will be really, really happy to have my own hedge fund. The thing is, in Europe, it's super hard. It's super hard to raise money. But that's, if you ask me, those are the two are really, really good. In Europe, it's hard to find jobs in prop trading. I think it's easier in hedge funds, but it's limited. And what is the best in order to get the best route to get a job in hedge fund? What is the best way? I think you need to have a book. Having a book and having some kind of track record is helping you. So if you think about the competition, you have thousands of people that want to do work in the hedge fund industry, and you get thousands of people that have done the CFA. So you all look the same. And that means if you say, oh, I've done the CFA, I'm coming from this university, there is no difference. If you come and say, look, actually, I've been trading X and X, I can give you what I've been doing. And it doesn't matter if it's on $20,000 or on $10,000. It's just that it tells you that you get, I mean, I hate this term, but money in the game. I remember in 2000 when I was looking for a job, I think the only difference, the only reason I had access to this job is I was saying, you know, I'm trading the market. And I said, you know, I'm trading. And at that time I was losing money. But because I was if you just say, I like it, but no, I do paper trade, or no, I'm just following the market, it's not enough. So start with having your own book, Christopher. I think that will help. What about we give it a night, because tomorrow morning the equity market is opening again. Tomorrow NFP, as usual, there's going to be a lot of noise. Market closed at all-time high. Be careful again. Some people are making jokes and saying, look, Greg, you know, he's boring because he's always talking about risk management and gross exposure and stop loss. Look, last week we got a 10 billion fund that did some trouble. It was all about risk management. You can be wrong and wrong and wrong, but if you get risk management, you're still in the game. If you're wrong and you don't have any risk management, you're out of the game. And then you'll have to come back in 5 years' time when you're going to be saving a bit of money. So do that. Be careful. I hope these webinars help. Again, I'll try to do one probably in 2 weeks, because I'm a bit more busy with the trading and the mentoring, because, you know, my priorities these days is those two things, mentoring and trading. So I still get pretty 5 to 10 mentees. So I try to give them the same service as usual. So thank you very much. If you have questions, send me an email. I try to come back to you as quickly as possible, and we can even have a call. Thank you to all of you. Bye-bye.